China has rolled out a genuine electric vehicle priced under $10,000, and millions of people are already driving one. This isn't a concept car or a prototype. It has real seats, real range, and a price so low that most Americans assume they've misheard it the first time. And here's the uncomfortable part. While the average new car in the U.S. now costs nearly $50,000, Chinese automakers figured out how to build something that gets people to work, school, and the grocery store for a small fraction of that price. The rest of the world has noticed. This isn't really a story about one cheap car. It's about a fundamental rewrite of how vehicles get designed, priced, and sold. A shift already reshaping markets in Europe, Southeast Asia, and Latin America. It's a shift that has some of the most established car companies on the planet quietly reconsidering everything they assumed about what buyers want and what they're willing to spend. Stop and think about that. Companies that have ruled the global auto industry for over a century, with hundreds of thousands of employees, billion-dollar factories, and decades of brand loyalty, are nervous, not panicking publicly, but nervous in the rooms where the real decisions get made. By the end of this, you'll understand exactly how this happened, why it matters well beyond China's borders, and what it might mean for the car parked in your driveway or the one you're currently saving up for. And there was a time when buying a new car in America was simply something ordinary people did without much drama. You saved a bit, walked into a dealership, picked something sensible, and drove it home. No 6-year loan. No anxiety over the monthly bill. For generations, that first car represented something real. Independence, freedom, the start of a life you were building. A young person with their first job could walk out of a dealership with something brand new. A working family could trade up without rearranging their entire budget. A retiree on a fixed income could buy something dependable without draining their savings. That kind of accessibility wasn't a fantasy, it was just how the market functioned. Somewhere along the way, that changed, and it happened gradually enough that most people didn't notice until the affordable new car had simply vanished. Vehicles got bigger, then heavier, then loaded with features nobody specifically asked for, but that ended up standard on every model anyway. Massive touchscreens dominating the dashboard, sensors packed into every panel, driver assist systems bundled into packages you couldn't decline, premium sound systems, ambient lighting, wireless charging, panoramic sunroofs, software subscriptions baked in before the car even left the factory. Each edition seemed reasonable on its own, but together they pushed prices up steadily year after year, until sticker prices bore little resemblance to what cars used to cost. Today, the average new vehicle in America runs close to $50,000. Sit with that for a second. That's not a loaded luxury trim or a performance model with a hand-built engine. That's the average, the middle of the market. What a regular buyer pays on a regular budget, that figure exceeds what many Americans paid for their first home a generation ago. It rivals several years of rent in plenty of mid-sized cities. It's comparable to a public university education, and it's now simply the entry price for driving something new off a lot. Meanwhile, everything else got more expensive too. Rent climbed sharply across most major cities over the past 2 decades. Grocery prices crept upward, then spiked during periods of high inflation. Healthcare costs kept rising regardless of broader economic conditions, and wages for most working Americans failed to keep pace with any of it. People adapted the way people always do, buying used instead of new. Stretching into longer loan terms, 6-year financing became standard, then 7-year loans started showing up too. People squeezed their monthly budgets uncomfortably just to maintain basic transportation. The practical, no-frills, get-me-there car that generations of families had relied on simply stopped existing as a real option. No company made an announcement about it. No industry body declared the affordable car retired. It just quietly faded, replaced by pricier vehicles loaded with features nobody asked for. And for years, no major automaker stepped in to fill that gap. It just sat there widening, waiting for someone to notice. Someone did, and they'd been quietly building toward an answer for a long time. To understand what China did with EVs, you need to know where they started. For most of the 20th century, China barely registered in the global auto industry. Early Chinese vehicles were often built on outdated foreign designs, assembled in factories lacking the precision of their German, Japanese, or American counterparts. Nobody in Detroit or Stuttgart was losing sleep over Chinese competition. And that changed in the 2000s, when China's government made a deliberate bet. Electric vehicles would define the next era of transportation, and China intended to be at the center of it. Money poured into battery research. New factories went up. Charging networks spread across cities, and incentives encouraged both manufacturers and consumers to go electric. The investment was massive and, crucially, sustained over years rather than announced once and forgotten. What mattered most wasn't just the scale of investment, it was the direction. Rather than chasing German luxury, prestige, or American truck capability, Chinese automakers asked a deceptively simple question. What does an average person actually need from a car? Not what looks dramatic in a commercial filmed on a mountain road, not what wins a magazine comparison test, but what does someone managing a real job and a real budget actually need on an ordinary Tuesday? The honest answer turns out to be modest. Getting to work, dropping kids at school, grocery runs, the occasional weekend errand, that's the overwhelming majority of what most people actually use a car for. Not cross-country road trips or off-roading or towing. So Chinese manufacturers began building vehicles for exactly that reality. Batteries sized for realistic daily distances rather than theoretical maximum range. Interiors built around features people actually use rather than an exhaustive catalog of extras. Lighter overall construction, since a lighter car needs less energy and a smaller battery. And simpler systems with fewer components, meaning fewer things to build, assemble, or break. Each decision saved a modest amount individually, but stacked across an entire vehicle, those savings compounded into a price the traditional industry had largely written off as impossible for a real roadworthy car. Less somehow became more, and the market's reaction to that idea was about to surprise everyone watching. It didn't look like a revolution. Honestly, it barely looked finished. The Wuling Mini rolled off Chinese production lines, small, boxy, and almost defiantly plain. No sweeping design lines, no aggressive styling. Nothing that suggested a design team had labored over it in a wind tunnel. Western industry observers mostly smiled and moved on, filing it away as a quirky product suited to a specific developing market, not a real competitive threat. And then the sales figures arrived. In its first full year, hundreds of thousands of people bought one, and the numbers kept climbing every quarter. At its peak, the Wuling Mini ranked among the best-selling electric vehicles anywhere in the world, sitting alongside brands that had spent decades and billions building their reputations. The people laughing stopped laughing pretty quickly. Here's the detail that mattered most. Buyers weren't choosing it because they had no alternative. Many already owned a car and added this as a second vehicle. Some were younger buyers, making a deliberate first purchase. Others were older drivers downsizing. They bought it because it was enough. Enough range for the daily commute, enough space for everyday life, enough features for genuine comfort, enough reliability to trust. Not impressive across every category, just solidly, dependably sufficient. And that idea of enough turned out to be one of the most disruptive concepts the auto industry had encountered in years. And the modern car business runs on a single direction: more power, more screens, more size, more luxury touches, because more lets manufacturers charge more, which produces better margins, which keeps shareholders and executives happy. The industry spent decades training buyers to expect more every model year, and buyers spent decades paying for it without questioning the value. The Wuling Mini sitting there boxy and cheap, quietly asked an uncomfortable question precisely because it was so reasonable. What if a huge number of buyers don't actually want more? What if they just want something that solves their daily problem at a price that fits their actual budget? That question started spreading through the industry slowly, then much faster, and understanding why requires looking at something rarely discussed outside engineering departments: weight. Most conversations about expensive cars focus on branding, technology, or raw material costs, and those matter. But there's a more fundamental issue underneath. Modern cars are extraordinarily heavy, not in the old way with thick steel frames, but in a newer way, driven by EV battery weight stacked on top of decades of accumulated features and structural reinforcement. Many of America's best-selling EVs weigh over 4,500 pounds. Some larger models exceed 6,000, approaching the weight of older military transport vehicles typically used to move one person from a house to an office and back. Trace what that weight actually costs. A heavier vehicle needs more power to move, which demands a bigger battery, which requires more lithium, cobalt, nickel, and manganese, meaning more mining, processing, shipping, and assembly labor. Every link in that chain adds costs before a single optional feature gets installed. It's a self-reinforcing cycle. Extra weight demands more battery capacity. More battery capacity drives up material costs. Higher material costs push up manufacturing price, and a higher manufacturing price means a higher sticker price. What Chinese manufacturers realized was that this chain could be interrupted right at the start. Build a lighter vehicle sized for how people actually drive rather than for hypothetical worst-case scenarios, and the entire cost structure shifts. The cheapest battery is the one your car doesn't need because it's light enough to run efficiently on a smaller pack. The cheapest feature is the one you never install because most drivers would never use it. Picture someone handing you a backpack already loaded with 2 weeks of gear for a 2-day trip, a heavy tent for camping you won't do, boots for trails you won't walk, rain gear for weather that won't come. You're carrying and paying for every unnecessary ounce. That's essentially what happened to cars over the past 30 years. Capability piled on for worst-case scenarios most drivers rarely encounter. Long-range batteries for the road trip, taken once a year. Towing capacity for trailers never attached. Off-road suspension for pavement that never ends. The price rose to reflect all of it, whether or not any individual buyer needed it. Chinese EV makers essentially looked at that overstuffed backpack and asked what the traveler actually needed for the trip they were actually taking. Lighter vehicles, batteries calibrated to realistic daily range. Simpler mechanical systems with fewer parts. Each saving was modest alone, but together they produced a price point the rest of the industry had stopped believing was achievable. And that approach didn't stay confined to one country. For years, the American auto industry felt genuinely unbothered by Chinese vehicles, and that confidence wasn't baseless. Chinese brands had no real U.S. presence. Regulatory hurdles were significant. And the prevailing belief was that American buyers would always pick bigger and more powerful when given the option. Detroit built 4 decades of profit around that assumption, and the numbers backed it up. The Ford F-150 has been America's best-selling vehicle for more than 40 consecutive years. That kind of consistency reflects something real. Americans do want large, capable vehicles. And domestic manufacturers built an entire business around supplying them. But a model that works brilliantly under one set of conditions can become fragile when those conditions shift, and several things are shifting at once. First, economics. $50,000 average prices, combined with higher loan rates, have pushed monthly payments to levels straining household budgets. A $70,000 truck financed over 7 years can produce a payment that rivals rent in parts of the country, and for a growing share of buyers, that math simply doesn't work. Second, generational change. Younger buyers entering the market grew up watching technology get dramatically cheaper, watching smartphones go from luxury items to commodities, and they look at rising car prices with skepticism rather than acceptance. Third, The gap Detroit created itself by shifting away from compact and mid-sized cars toward higher-margin trucks and SUVs. Domestic manufacturers left a huge swath of buyers who need practical, affordable transportation with far fewer new options than they had 2 decades ago. That gap is sitting there, waiting. Picture two neighbors. One finances a $70,000 truck over 7 years, paying interest, higher insurance, and gas for a large engine for nearly a decade. The other buys a $12,000 city EV outright, no monthly payment. Cheaper insurance, electricity instead of gas. Both solve the identical daily problem: work, school runs, groceries, but the financial outcomes couldn't be more different. As more people make that comparison out loud, the conversation shifts, and it's already happening in comment sections, finance forums, and around kitchen tables. And the domestic industry has lived through this kind of disruption before. In the 1970s, American automakers dismissed compact Japanese imports as irrelevant to American tastes until the oil crisis hit. Fuel prices spiked, and millions of consumers suddenly cared a great deal about fuel-efficient, affordable Japanese cars. Toyota, Honda, and Nissan went from foreign curiosities to permanent fixtures within a single generation. And Detroit never fully recovered the ground it lost. The affordable EV story hasn't stayed inside China. It's spreading faster than most expected in Europe, where fuel has historically cost more than streets are narrower. Smaller, affordable vehicles already had a natural audience, and regulators pushing emission standards have created real pressure for automakers to deliver electric options ordinary buyers can actually afford. Chinese manufacturers have moved into that opening steadily, gaining share across multiple European markets year after year in Southeast Asia, Latin America, and parts of Africa, where incomes are lower. The math is even more compelling. A dependable vehicle for $8,000 to $12,000 doesn't just represent a purchase decision, it represents access to car ownership that simply didn't exist before. All of that growth is quietly doing something important for Chinese manufacturers, building scale that's genuinely hard to match. Selling across dozens of markets simultaneously drives total volume up, which pushes per-unit manufacturing costs down, which allows prices to fall further, which brings in more buyers, which raises volume again. A compounding cycle that gets harder for competitors to match without rethinking their entire approach to vehicle design. American and European manufacturers aren't standing still. Volkswagen has talked about targeting much lower price points for future EVs. General Motors has announced plans for more affordable models, and Ford has committed to aggressive cost cutting. The recognition that something needs to change is clearly there, but recognizing that and actually executing it are very different challenges for organizations built around complexity, established supplier networks, and high-margin products. Rewiring all of that takes years and requires decisions that cut directly into the profits currently keeping these companies running. Meanwhile, the underlying question isn't going away. Why does a new car cost this much? What am I actually paying for? Is there a better option?